I need you to lock in right now, because what I'm about to show you is not speculation. It's not a theory. It's not a maybe. It's already happening. Between February 3rd and February 7th, 2026, regional banks across the Midwest and Southeast processed withdrawal requests totaling $47 billion. Let me say that again, slowly. $47 billion. And that's not a yearly number. That's not a monthly trend. That's a 5-day window. And the most dangerous part? Almost nobody is talking about it. Not because it isn't real, but because the way it's happening is too quiet to scare the public. This number isn't coming from conspiracy blogs. It isn't coming from random Twitter accounts. It's buried inside the Federal Reserve's H8 data release, the weekly report on the assets and liabilities of commercial banks. A report most investors never read, most journalists don't understand, and most depositors don't even know exists. Now, listen carefully. This is not the kind of bank run people imagine. This is in the 1930s. There are no long lines outside bank branches, no screaming crowds, no viral videos of people banging on locked doors. Modern bank runs don't look like chaos. Modern bank runs look like silence. They happen in boardrooms. They happen through wires. They happen through treasury management dashboards. And they happen before you ever realize anything is wrong. Because this isn't the public running to withdraw cash. This is the smart money leaving first. Institutional client, corporate treasury departments, family offices, high net worth individuals, people who read balance sheets the way you read headlines. And they're moving their money out of regional banks into money market funds, short-term treasuries, and in many cases, physical assets that exist completely outside the banking system. And here's why the media isn't covering it. Because the mechanism is moving at the perfect speed, slow enough to avoid triggering immediate FDIC intervention protocols, but fast enough that by the time the average depositor understands what's happening, the banks will already be forced into emergency mergers, recapitalization events, or outright resolution. And if you think your deposits are safe because of FDIC insurance, I need you to understand something that will permanently change the way you look at your money. The FDIC insurance fund holds around $128 billion. Total insured deposits in the United States banking system exceed $10 trillion. That means the FDIC fund covers Phase 1 is institutional repositioning. This is when large depositors, corporations, pension funds, family offices, start moving deposits in amounts that trigger internal risk alarms, but don't yet trigger public panic. These moves are quiet. They're spread across multiple transactions, and they're rationalized as routine cash management. Banks report them as normal fluctuations. But behind the scenes, executives are watching those numbers like a heart monitor. Phase 2 is where it gets dangerous, because once that first wave moves out, banks are forced to meet withdrawal requests. And to do that, they have to raise cash, which means they have to liquidate assets. And here's the trap. Many of those assets are held at a loss because of the interest rate environment we've been living in since 2022. So when banks liquidate, those losses become real. They crystallize. And once those losses show up in quarterly earnings, the next wave begins. The smarter depositors, those who actually read financial statements, see the realized losses and understand the truth. Unrealized losses becoming realized losses is not a small accounting detail. It is the moment the mask comes off. And then we enter Phase 3, public awareness. This is when the story breaks. Regional media starts whispering. Social media starts amplifying. Retail depositors start moving their funds. And by that point, it's already over. The bank is already in emergency discussions with regulators, already negotiating liquidity facilities, already hunting for an acquirer. And if you're a depositor in Phase 3, you're no longer protecting your wealth. You're hoping. You're praying the FDIC process runs smoothly. You're praying your funds above the insurance limit are eventually made whole through a claims process that can take months, sometimes years. The core thesis of this entire breakdown is simple. We are currently in Phase 2. And the banks being hit hardest are regional banks with concentrated exposure to three things: commercial real estate, long-duration securities, and depositor bases that skew institutional rather than retail. And what's driving this isn't emotional. It's mathematical. These banks are holding assets that have declined in market value by 15% to 30%, while their deposit liabilities remain at par. That gap is a solvency problem, but it has been hidden by accounting rules. Rules that allow banks to carry certain securities at amortized cost instead of marking them to market. In other words, the balance sheet looks healthy until depositors withdraw. Because when depositors withdraw, the bank has to sell. And when it sells, the fiction ends. The losses become real. And here's the asymmetry. Informed depositors are moving now, before the public phase. Uninformed depositors are waiting for confirmation. But confirmation only arrives after your optionality is gone. That's the key. The sequence matters more than the magnitude. Moving early, before you feel like you need to, is the only strategy that guarantees you remain in control of your capital. Now, let's ground this in history, because what you're seeing right now has happened before, twice, with precision. And the people who recognized the early stages and acted decisively didn't just preserve their wealth, they multiplied it. The first parallel is the banking panic of 1930 to 1933. Most people remember the stock market crash of 1929, but the real systemic destruction happened in the banking sector. Between 1930 and 1933, more than 9,000 banks failed in the United States. These weren't just tiny rural institutions. These were banks holding the deposits of businesses, farmers, families, people who believed their money was safe. And the mechanism was identical. Banks had lent aggressively during the 1920s expansion, especially into real estate and agricultural loans. When asset values collapsed and borrowers defaulted, banks were left holding collateral worth far less than the loan balances. Depositors began to worry. They withdrew. Banks liquidated. Losses grew. Confidence collapsed. Withdrawals accelerated. And the system froze. Now here's the most important part. The depositors who lost everything weren't the ones who were wrong about the economy. They were the ones who waited. They believed their bank was different. They believed their relationship mattered. They believed the government would step in fast enough. And by the time they tried to withdraw, the bank was already closed. The depositors who preserved their wealth moved early, even when it felt uncomfortable, even when it felt paranoid, even when their friends told them they were overreacting. They withdrew cash. They moved funds to stronger institutions. Or they converted deposits into gold before Executive Order 6102 in 1933, which made private gold ownership illegal. The lesson from the 1930s is not that every bank will fail. The lesson is this: in a cascading withdrawal environment, timing is the only variable that matters. Once the public phase begins, your options disappear, and confidence, once broken, cannot be restored through press releases, speeches, or reassurance. The second historical parallel is the savings and loan crisis of the 1980s and early 1990s. This crisis doesn't get discussed enough today, but offers a perfect blueprint for what's unfolding now. Savings and loans were specialized banks focused on mortgage lending. During the 1970s, they issued long-term fixed-rate mortgages at 5% to 7%. Then Paul Volcker raised the federal funds rate to 20% in 1981 to crush inflation. And suddenly, S&LS were trapped. They had to pay depositors 12% to 15% to keep deposits. But their mortgage portfolios were only earning 5% to 7%. The math was suicidal. For every dollar they held in deposits, they were losing money. Over the 1980s, more than 1,000 S&LS failed. The Resolution Trust Corporation was created. Taxpayer costs exceeded $130 billion. But here's what matters for today. The institutions that failed first weren't always the ones with the worst loan portfolios. They were the ones that experienced the first wave of deposit withdrawals. Because once depositors started moving, The SNLS had to liquidate assets at a loss, which made the insolvency visible, which triggered faster withdrawals, and the cycle fed itself. The lesson is simple. Interest rate mismatches create solvency problems, not liquidity problems. And solvency problems cannot be fixed by central bank lending facilities. They can only be solved by recapitalization, merger, or liquidation. And in every one of those scenarios, depositors above the insurance limit take losses. Now, let's connect this to February 2026. According to the Federal Reserve's H8 data, commercial banks reduced total deposit liabilities by $47 billion in the week ending February 7th. Now by itself, a weekly deposit decline isn't unprecedented. Deposits fluctuate due to tax payments, corporate cash cycles, seasonal trends. But when you break down the composition, that's where the alarm bells start screaming. The largest declines were concentrated in large time deposits and transaction accounts at domestically chartered commercial banks, excluding the top 25 largest institutions. Let me translate that into plain language. Institutional depositors are pulling funds, specifically from regional and community banks, and they're doing it in a way that doesn't look like routine cash management. It looks like risk reduction. Now why? The answer is on the asset side of the balance sheet. During the zero interest rate era from 2008 to 2021, regional banks accumulated massive portfolios of long-duration securities, mortgage-backed securities, treasury bonds, because they offered a yield premium over cash and were considered safe. But then the Federal Reserve raised rates from near zero to over 5% in less than 2 years, and the market value of those securities collapsed. A 10-year Treasury bond issued at a 2% coupon in 2020 is now worth roughly 85 cents on the dollar, because new bonds yield closer to 4.5% to 5%. A 30-year mortgage-backed security issued at 3%, worth even less. And banks don't have to recognize those losses, as long as they classify them as held to maturity. But those losses are still real. They're just hidden. And the moment depositors withdraw, the bank faces a choice: borrow from emergency facilities or sell assets and take the loss. In early 2023, when Silicon Valley Bank failed, we saw exactly how fast this can move. SVB experienced $42 billion in deposit outflows in a single day that forced them to sell securities and realize a $1.8 billion loss. That loss showed up in an 8K filing. Within 48 hours, depositors tried to withdraw another $100 billion. The run happened in 72 hours, entirely electronically. And by the time retail depositors understood what was happening, the bank was already closed. Now what we're seeing in February 2026 is the early stage version of the same dynamic. But instead of one bank collapsing instantly, it's distributed across multiple regional banks. And that makes it even more dangerous, because the public doesn't see it as one dramatic event. They see it as nothing. But the $47 billion withdrawal figure represents roughly 1.2% of total deposits at regional banks outside the top 25. That might sound small, but the velocity is what matters. If that rate continues for 4 weeks, you're looking at a 5% decline in deposits. And at that threshold, banks are forced to start liquidating securities portfolios. And once those liquidations show up as realized losses, the next wave accelerates. The cascade is already in motion. The only question is how fast it moves and which institutions enter resolution first. Now here's the part most depositors don't understand. And this is where people are dangerously misinformed. The legal framework governing bank failures changed fundamentally after 2008. Title II of the Dodd-Frank Act, signed into law in 2010, gave the FDIC authority to place large institutions into a resolution process called Orderly Liquidation Authority. And inside that authority is a mechanism most people have never heard of, but will never forget once they understand it: the bail-in. Here's how it works. When a bank enters receivership, shareholders are wiped out. That's normal. Bondholders take losses. Their bonds are written down or converted into equity. And then, if additional capital is needed, the FDIC has the authority to convert uninsured deposits, meaning deposits above the $250,000 limit, into equity in a bridge bank or restructured entity. This is not theoretical. This exact process happened in Cyprus in 2013. Depositors with balances over 100,000 euros had up to 47.5% of their deposits converted into equity that was worth a fraction of the original deposit value. Many never recovered the full amount. And the same framework exists in the US. And that matters because the majority of large depositors in regional banks are not rich hedge funds. They're businesses, law firms, medical practices, construction companies, real estate firms, payroll accounts. A law firm with 50 employees might keep $5 million in operating cash. Under current rules, $250,000 is insured. The remaining $4.75 million is an unsecured liability. And if the bank fails, that $4.75 million can be converted into equity, worth 20 cents on the dollar, or less. And that's exactly why institutional depositors are moving now. They're not waiting to see if their bank will be one of the lucky ones. They're eliminating the risk. Now let me make this even more real. In 2023, when First Republic Bank was seized by the FDIC and sold to JP Morgan Chase, the bank had around $104 billion in deposits. About $90 billion of that was uninsured. Those depositors were made whole, only because JP Morgan agreed to assume all deposits. But that outcome was not guaranteed. If JP Morgan had declined, or if the deal excluded uninsured deposits, those depositors would have become unsecured creditors. They would have filed claims. They would have waited months or years and recovered 60 to 80 cents on the dollar if they were lucky. First Republic depositors got lucky because one healthy acquirer stepped in. But here's the nightmare scenario. If multiple regional banks enter resolution simultaneously, there will not be enough healthy acquirers to assume all uninsured deposits. And at that point, the bail-in framework becomes the primary tool, and uninsured depositors take losses. Now you understand why smart money is moving. So now we get to the part that matters most. What do you do? Not in theory, not someday, not when things get worse. Right now, there are 3 asymmetric moves you need to make immediately. Move 1. Immediate deposit reallocation. If you have any accounts above the FDIC limit, you need to move those funds this week. Not next month, this week. Because the moment the public phase begins, banks will impose friction, transfer delays, withdrawal limits, internal reviews, and you will suddenly discover that your money is not as liquid as you thought. The mechanics are simple. Split deposits across multiple banks to stay under the insurance limit at each. Move funds into a money market fund that holds Treasury securities, or buy short-term Treasury bills directly through Treasury Direct or brokerage. The key is eliminating exposure to uninsured deposits in vulnerable regional and community banks. The asymmetry is brutal. Moving now costs you almost nothing. The yield difference between a savings account and a Treasury money market fund is negligible, sometimes 10 to 20 basis points. But the downside risk of staying is a potential 50% to 100% loss of the uninsured portion if the bank enters resolution. That's not a trade. That's a risk management decision. If you run a business, sit down with your accountant or CFO this week. Map out every account, every payroll account, every operating account, every trust account. And if any single account exceeds the limit, restructure immediately. The cost of action is basically zero. The cost of inaction can destroy your business overnight. Move 2. Establish a position in physical precious metals. Gold and silver are not investments in this context. They are insurance. They are the only assets with zero counterparty risk. They exist outside the banking system. They cannot be frozen with a click. They cannot be converted into equity in a failing institution. They are final settlement. Right now, gold is trading near 2,700 per ounce. Silver is around 31 per ounce. Yes, those are elevated levels compared to some historical averages. But adjusted for inflation, gold is still far below its 1980 peak. Silver is even further below. And the reason metals matter in a bank-run environment is simple. When confidence collapses, people don't rush into bank deposits. They rush out of them. They rush into assets that don't require trust. And gold and silver are the oldest trustless assets on Earth. Your allocation should be meaningful. 10% to 20% of liquid net worth minimum. If you truly understand systemic risk, 30% is not insane. Buy physical bars and coins from reputable dealers. Avoid collectibles. Avoid numismatic premiums. Store it in a safe or in a fully allocated, segregated vault where you own specific serial number bars. Because the entire point is to hold something that cannot be restructured by a failing institution. Move 3. Build exposure to senior secured credit in distress situations. This is more sophisticated, but the upside asymmetry is enormous. As regional banks are forced to raise cash, they will liquidate loan portfolios, commercial real estate loans, middle market corporate loans, asset-backed securities, and they will sell them at steep discounts because they'll be forced sellers. Senior secured debt means you have first lien on collateral. So even in bankruptcy, you are at the front of the line. The opportunity is buying loans at 60 to 70 cents on the dollar, then either collecting par at maturity or restructuring or taking control of the underlying asset. For retail investors, the easiest access is through closed-end funds and business development companies that specialize in distress credit. These vehicles often trade at discounts to net asset value before a distress cycle becomes obvious. Then, as they deploy capital into high-yield opportunities, the discount closes, and you capture both income and capital appreciation. Firms like Oaktree, Apollo, and Ares built empires buying distressed assets in 2008, and the setup today is similar. Banks are holding assets they need to sell. Distressed credit funds are sitting on record dry powder. And the spread between forced selling and patient capital creates opportunities that disappear the moment the story becomes headline news. Now, I want to show you the signals, the hard indicators that this withdrawal cascade is accelerating because the data is not ambiguous. In addition to the 47 billion deposit decline, 3 other indicators are flashing red. First, emergency liquidity facility utilization is rising. Banks are borrowing more. That means they're meeting outflows without selling assets at a loss. This is not strength. This is a bank tapping its credit line, not because it's expanding, but because it's trying to survive. Second, the spread between the effective federal funds rate and what banks are paying on deposits has widened massively. In a normal environment, that spread is 50 to 100 basis points. A wide spread means banks are desperate to retain deposits. They're paying above market to stop the bleeding. But here's the trap. Paying higher rates on deposits while holding assets yielding far less accelerates insolvency. It's a short-term patch. That makes the long-term problem worse. Third, commercial real estate delinquencies at regional banks are rising aggressively. And that matters because commercial real estate is not a side business for these banks. It is often 30% to 40% of their loan portfolios. So when delinquencies rise, loss provisions eat capital. Capital declines. Balance sheet stress becomes visible, and depositors react. These are the same early warning signals that preceded bank failures in 2008 and the S&L crisis in the 1980s. The pattern repeats because the math repeats. Now, let's address the question you're probably thinking. If this is real, why isn't mainstream media screaming about it? 2 reasons. First, the withdrawal process is slow enough that it doesn't meet the editorial threshold for breaking news. A 47 billion deposit decline sounds massive to people who understand banking, but to mainstream audiences, it's just another number. The media covers bank runs when there are lines outside branches. They don't cover institutional withdrawal phases. Second, there is a vested interest in maintaining confidence. Regulators, executives, policymakers, they know public awareness accelerates the cascade. So the communication strategy is always the same. Minimize. Frame it as temporary. Emphasize FDIC insurance. But that strategy creates a deadly information gap because institutional clients already see the risk. They're already moving. Retail depositors are the last to know. And by the time they know, it's too late. That's exactly what happened with Silicon Valley Bank. Institutional depositors moved funds Thursday. By Friday morning, it was a run. By Friday afternoon, it was in receivership. Retail depositors found out from headlines. They never had a chance. That's not luck. That's information asymmetry. And it's happening again. So here's the question I want you to answer in the comments. And I want real answers. Do you currently have deposits above the FDIC insurance limit in a regional or community bank? And if you do, are you reallocating this week? Or are you waiting? Because the decisions you make over the next 2 weeks will determine whether you're positioned ahead of this cascade or caught inside it. And if this breakdown helped you, if you understand why this withdrawal data matters and why the media silence is more concerning than reassuring, then do 2 things right now. First, hit subscribe and turn on notifications because I'm tracking this weekly, and I will update you as the situation evolves. This is not entertainment. This is real-time risk analysis, and it could determine whether you preserve your wealth or watch it get trapped inside a resolution process. Second, share this video with anyone you know who runs a business, who has operating cash in a bank, who manages payroll, who keeps trust funds, who has significant deposits sitting in a regional institution because their bank will never call them and tell them to move their money. By the time the bank is in distress, it will already be too late. The withdrawal cascade is happening now. The mechanics are mathematical, not emotional. The asymmetry is brutal. Informed depositors are moving. Uninformed depositors are waiting. The only question is, which side of that divide you're going to be on? I'll see you in the next one.